If the last few months have made one thing clear, it's this: Donald Trump is all in on tariffs. He's dead set on eliminating trade deficits. And in his mind, tariffs are the silver bullet to get that done. But here's the catch. Most economists don't see it that way. They argue that tariffs aren't a smart solution to the trade imbalance. And Trump's dream of reviving American industry to build a self-sustaining manufacturing powerhouse? Well, it's looking pretty unrealistic right now. Still, if tariffs don't deliver the results he's hoping for, Trump may have another card up his sleeve, one that's even more unconventional. What if, instead of taxing goods, he taxed money itself? In this video, we're going to break down what it actually means to tariff money, how it could potentially fix the trade deficit, whether it's likely to happen, and if it could really work. To understand this idea, we first need to talk about how trade deficits work. A trade deficit happens when a country buys more from abroad than it sells. In simple terms, more imports, fewer exports. Now, traditional economic theory says this kind of imbalance shouldn't last forever. Why? Because importing more than you export usually weakens your currency. When a country imports goods, it has to exchange its own currency for foreign money to pay for them. That leads to more selling of the home currency. Meanwhile, when a country exports, foreign buyers need to buy that country's currency to purchase its products. That increases demand for the currency. So when imports outweigh exports, there's more selling than buying of the currency. And that should cause its value to drop. A weaker currency makes imports more expensive and exports cheaper. That shift should help balance things out over time. But here's the puzzle. The US has been running a trade deficit for decades, and the dollar hasn't weakened the way you'd expect. Why not? Because money is constantly flowing into the US. Those steady capital inflows prop up the dollar's value, preventing it from falling and keeping the trade deficit alive. In fact, these capital inflows are what actually fund the trade deficit. So why is so much foreign money pouring into the US? Part of the reason is that the US is a great place to invest. It's a massive, stable economy with strong legal protections and deep financial markets. But a bigger reason is that global investors see the US dollar and US assets as safe havens. Treasury bonds, in particular, are viewed as ultra-safe. This trust is what gives the dollar its role as the world's reserve currency. Think of it this way. Dollars and US treasuries are America's biggest exports. But because they aren't physical goods or services, they don't show up in trade statistics. So even though America is exporting financial assets at massive scale, it still looks like it's running a giant trade deficit. This brings us to the core idea. The US's persistent trade deficit is the flip side of its consistent capital surplus. In other words, America can afford to import more than it exports only because money keeps flooding in from abroad. And this is where the idea of tariffing money comes into play. Some outside-the-box economists argue, instead of trying to cut down on imports like Trump is doing with tariffs, why not reduce the amount of money flowing into the country? Now, this idea might seem like a sharp break from US policy. For decades, America has promoted free capital movement around the world, encouraging other countries to open their markets to American investment. But this isn't a completely new concept. Back in 2019, during the tail end of Trump's first term, Republican Senator Josh Hawley and Democrat Tammy Baldwin introduced a bold proposal. They wanted to impose a market access charge on all foreign purchases of US financial assets like stocks and bonds. In other words, tax the money flowing into the country. Their bill didn't go anywhere at the time, but the idea resurfaced in 2024. A conservative think tank called American Compass, closely aligned with Senator J.D. Vance, came out in support of a 0.5% fee on all foreign investment in U.S. financial assets. Just days later, the White House issued an executive order, the America First Investment Policy. It called for a review of a 1984 treaty that, among other things, eliminated a 30% tax on capital coming in from China. So the question is, could this really happen? Could Trump actually slap a tariff on capital inflows? Right now, Trump still seems focused on traditional tariffs to tackle the trade deficit. But if those don't work, which, let's be honest, most economists believe they won't, then targeting capital inflows could become a serious option. And here's the thing. From Trump's perspective, this strategy actually has a lot going for it. First of all, it wouldn't cause nearly as much inflation as import tariffs do, nor would it wreck supply chains or burden American businesses as directly. Second, it could generate as much, if not more, revenue than tariffs. And Trump loves to talk about how much money tariffs bring in. While the numbers on tariff revenue vary, most estimates suggest they raise around $200 billion a year. A 0.5% fee on capital inflows could match or even exceed that, considering the U.S. receives about $60 trillion in capital inflows every year. Third, the rate could be adjusted up or down depending on the economy's needs. If the trade deficit isn't shrinking, raise it. If U.S. companies suddenly need more foreign investment, lower it. Fourth, the burden of this kind of policy would fall mostly on large financial institutions, not on everyday Americans or small manufacturers who often take the hit from tariffs. Fifth, a one-time or modest fee like this would mostly discourage short-term speculation, without scaring away serious long-term investment. For example, a fee like this might deter a hedge fund from rapidly trading U.S. stocks, but it wouldn't stop a company like TSMC from building billion-dollar chip factories in Arizona. That said, tariffing capital would mark a dramatic shift in America's long-standing economic philosophy. It would rattle powerful lobbying groups in Washington and could cause short-term turbulence in financial markets. But then again, Trump's tariffs are already doing those things. And if they don't work, targeting capital might just become a more attractive option. With that said, thanks for watching. And until next time.